Okay, class. So I guess we can start now. So good evening, everyone.
Good
You're
evening, sir.
welcome again you're welcome again to
Evening,
another
sir.
class. Good evening. You're welcome again to another class on strategic business reporting. Today, we're going to finish up with IFRS 13 on fair value measurement, and we're also going to look at some past questions. Hopefully, we would have additional time before our time is up to look at some. But we'll just scan through past questions and see what we can solve on on the topics we have covered so far. Okay, now we are on IFRS 13 on fair value measurement. This part of your syllabus is also a regular part that you would find the examiner asking you almost every diet. And what's this standard talking about? I told you before I gave you the definition that this standard established a single framework for the determination of fair value. So anywhere, anytime you hear about fair value, it is this standard that dictates or determines how we determine fair value. Though there are some parts, there are some standards that decides to determine fair value on their own, like fair value in the context of IAS 19, when I taught you about where the actuary will determine the fair value of the plan asset and also the fair value of the defined benefit obligation at the end of the year. That is determined based on IAS 19 principle, and also fair value in IFRS 2, where we talk about the fair value of the share option at the grant date. That also does not follow along with this IFRS 13. Also is IAS 2 on inventory. That also does not follow along. And also is IAS 36. When we talk about net realizable value, it does not also follow along or tag along with IFRS 13 determination of fair value. Every other standard does. And I told you that fair value is the amount that is received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. We looked at this definition, we broke it down into four elements. And the first was exit price. That to determine fair value, we make use of exit price. And I told you that from this definition, the first part of the definition, it indicates exit price, the price that is received to sell an asset or paid to transfer a liability. You are exiting that asset or liability. You have to be exiting it. It is the exit price that is the fair value. Then we also went ahead to look at fair value must happen in an orderly transaction between market participants at the measurement date. We we explained all of this. We explained all of this one by each. I told you that orderly transaction means that the transaction is not forced, and also the asset or liability that you want to sell, you marketed it. The buyers are aware of it. And a lot of people are coming to ask you about the assets, right? And also, eventually, there is now a striking price. That price can represent a fair value. And that transaction where you allowed the asset to be marketed for quite a number of period, right? That is what makes it orderly transaction. So we want to avoid a situation whereby you are desperate to sell at any price, that you want to sell before the end of the day. The price you will receive cannot be a fair value because we do not deem that kind of transaction as orderly. Also, you can only determine fair value when the transaction is consummated between market participants who are majorly people that have knowledge about the assets, who are buyers and sellers that are willing and they know a lot about the asset. So you can think about any asset like shares, for example. Now you want to get the fair value of shares. The buyer and the seller has to be people like stockbrokers, institutional investors, financial analysts, people that understand that ecosystem, that stock market. If they have to be the buyers and the seller and seller, it's just like maybe a bank like GT Bank wants to sell their shares, right? You need to look at who is buying those shares. If it's just a random person, then that is not the price that is received is not or cannot represent a fair value. It has to be either an institutional investor, a stockbroker, somebody that understands the market. And finally is measurement date. So fair value is, we don't want it to be historical. We want it to be the price at the transaction date. So the date at which you want to determine, you want to know that amount is the fair value. So fair value today might be different from fair value tomorrow for the same transaction. You might want to get the fair value of a property today. Today that you want to get and determine the fair value, that today is the measurement date. Tomorrow can also be a measure. So measurement date in this context is the date at which you want to determine the fair value. And for us, we usually cap it as mostly the 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 end of the year or the reporting date. Now, we went ahead to mention assumptions that are made by market participants that they mostly operate or this fair value is determined in the principal or the most advantageous markets. We explain that critically. And also, we also explain that market participants act in their own best interests. They are looking out for their own benefit. They want to maximize their own benefits. And I also explained that for non-financial assets, the fair value is determined based on its highest and best use, which is the use that generates the highest benefits for the asset, and it is the use that is financially feasible, physically possible, and legally permissible. Okay, so these are very important for you. It's important. And also, we then looked at, okay, aside using this definition, right, is there a scientific way, aside looking at, okay, is this the exit price? Is this transaction orderly? Are these people market participants? That takes a lot of effort. So the standard also gave us an alternative to determination of fair value. That is using a valuation technique or approach. And yeah, I told you last week that there are three of them. We have the income approach, we have the cost approach, and we have the market approach. The income approach, this uses discounted cash flow method, meaning that we would estimate future cash flows on that asset or liability, then we discount them to present value. Then the value you get is, that's the fair value using the income approach. Also, you can also use the cost approach. This is basically looking at the replacement cost of the assets, right? If I'm going to replace this asset today, how much? That can represent fair value. And you can also use market approach. And this is applicable where there is an active market for that asset, wherein you can get pricing information on that asset, right? That you can easily know, okay, this is the selling price as at today, right? So you can use market approach in that scenario. However, the standard clearly explains which of these approaches is the best by looking at fair value hierarchy. This is also a very important part of the standard. So this fair value hierarchy is indirectly telling us that out of those three approaches we mentioned up there are some that we really don't encourage. So it says that there is the one that is level one. He said that one is the most reliable. And he said here, the inputs or the way you determine your fair value is using market prices of an identical asset in an active market. You will see that that is synonymous to using market approach, because market approach is where you will use market prices. He says that this method is this level, this using this input is the most reliable because there are verifiable, observable inputs. The way you determine fair value, everybody can see it, everybody can verify it. It's just like you want to get the fair value of your shares in MTN. I mean, it's just for you to determine, okay, you can Google it and check the price of MTN shares today. I mean, we would agree that it's not all assets that would have such market prices that are publicly available, right? It's not all assets. So we agree that there will be some asset that you cannot get that prices outside. It's not available. And that's where level two works, which is for assets like probably maybe you have shares of a company that is not publicly quoted, for example, now. Like, I mean, you want to get the value of your shares in Glow, for example. Glow is not quoted, so there's no way you can use level one input. Then in that case, then okay, you can use level two input. So level two input is saying that okay, why don't you get a similar asset, then use the market price for that? Okay, just that level two input would therefore require adjustments because you cannot say, okay, I want to get the value of my shares in Glow, for example. You then say, okay, what's the similar shares to that of Glow? You say MTN. You then say, okay, what's the price of MTN shares? You say 250 naira. So you then use that 250 naira as a basis for valuing Glow. That will not work because those two businesses does not have the same business risk, and the level of management they have, the level of financial resources they have. I mean, their risk and operationalities are different. So you cannot then pick that share price, climb and sink. So you would need to make some adjustments to that. I mean, or for example, you want to get the fair value of your like a duplex, let's say in Magodo, for example, and there's no way you can know it. You just need to probably ask, okay, how much are they selling houses on these streets? And somebody tells you that I just sold a seven-bedroom duplex for 1 billion. Then you assume that, okay, yeah, so mine too is 1 billion. That will not work because you need to look at the characteristics of the asset vis-a-vis the characteristics of yours. So those are the challenges with level two. It requires adjustments. And that is where subjectivity comes. Okay, how do you adjust it? By what proportion? So you need to be, I mean, probably you would just say, okay, let's make a risk factor allowance of 20%. So let's say if the value of that one is 250, you say, okay, maybe mine should be 80% of that, something like that. So it's subjective also. So you get the idea why the standard is saying that, okay, yeah, level two is okay because to a large extent it's similar to market approach because you're using market information, but you're making adjustments. That's the downside of level two. Level three, we do not encourage it because this is only applicable for assets that there is no publicly available information, that you're only restricted to the company's internal data. And of course, it's typical for probably maybe you want to value a business, like a startup company, for example. There's really no viable way for you to get the value. I mean, you have to just make some estimates of future cash flows, then discount it to present value. So you'll probably be using income approach for those scenarios. So level three is more is gearing towards income approach. So really, what I've just taught you is really what you need to know as far as IFRS 13 is concerned, right? And the examiner would really test you around these areas in variety of ways, which we are going to look at tonight. So before we look at other questions, let's start with these questions we have in front of you. Okay, um, who reads for us, please? Let somebody read question one for us.
Okay, let me read question one.
Okay.
ABC Limited owns 5,000 shares of Dangote Cement PLC, a company listed on the Nigerian exchange on December 31st, 2024. The last traded price of Dangote Cement was 450 naira per share. Required. What is the fair value of ABC Limited investment in Dangote Cement? 2. Which valuation approach should be used? 3. Under which level of the fair value hierarchy does this measurement fall?
Okay, good. So this is a typical these are typical things you need to know here. So this one is ABC Limited. He owns 5,000 shares of Dangote, which is a listed company. And on year end, December 31st, 2024, the last traded price was 450. So I want to believe this is the measurement date. So we're now asked what's the fair value of this guy? I mean, the fair value is simply is the exit price, is the exit price of Dangote PLC, of Dangote Cement, which from the question is 450 naira, which is the price that that will be received to sell the shares at the measurement date. And in this case, the measurement date will definitely be December 31st, 2024. And that's 450 naira is the fair value. So if I want to cap it, the fair value is the fair value of the shares is 5,000 shares multiplied by 450 naira. So whatever you get, give you the fair value. Can somebody give us a figure so that we can have it in your working notes on the board? Need to be getting our calculator ready.
2,250,000.
2,250,000.
50,000.
That's the fair value. Okay, that's the number one. So the number two is asking for which valuation approach should be used. So, okay, the valuation approach here is, hey, can you tell me which approach we're using here? The valuation approach here is,
Market approach.
thank you very much, sir. Because we are using market information, publicly available information. So we are definitely using market approach. So what's the level of hierarchy here in this case? So the level of hierarchy, the level of fair value hierarchy is which level now? It's level 1 impute here. Okay, which uses market uh, market prices of identical assets in an active market. Okay, so this is a level 1 hierarchy, and this is the best. The standard loves this level. Okay, any questions on that? Okay, I think that's clear. So let's read question 2, please.
XYZ Real Estate Limited owns a shopping mall in Abuja. There is no active market for shopping malls in the area, but similar malls were sold for 5 billion naira, 5.5 billion naira, and 6 billion naira in recent transactions. Required 1. How should XYZ Limited estimate the fair value of the shopping mall? 2. What valuation approach is appropriate? 3. Under which level of the fair value hierarchy does this measurement fall?
Okay, now the asset we want to measure is a shopping mall. We're told clearly that there is no active market, but similar assets were sold for these prices in recent transaction. So here now, so the fair value would be the average price here of similar assets. Okay, and the average price here, the average price in the market is 5 billion plus 5.5 billion plus 6 billion divided by 3. So since we have 3 prices, just to get the average price in that market. So how much does that give us? How many billion?
5.5, sir.
That's also 5.5. So this will represent um the fair value. You see, you just have to, I mean, that's the best we can do. Ordinarily, if they are giving us the price of just one similar asset, that would have been very straightforward. Then probably they tell us that a similar asset in that area was sold for 6 billion. Then we will have just say 6 billion. But here, the examiner gave you 3 prices Just get the average. So don't say that Ashibi, I did not mention average. I mean, that's just I mean that means we can apply some common sense if I want to put it that way. So it's like the average price of similar assets, something like that. So the second one says that what valuation approach is this? So who can tell me which valuation approach is this?
Market value.
Thank you very much. Not market value, market approach. Okay, market approach, because we are still using publicly available information. Publicly available information. So what's the level of hierarchy here? The level of fair value hierarchy. Is it level 1?
Level
Is it
2.
2, sir, because we made some adjustments.
Thank you very much. So the level here is level 2 inputs because we used the market prices of a similar asset in an inactive market. Okay, based on the question told us, because that's level 2 when you are using price of a similar asset. Level 1 is you are using identical, that same asset is in the market and you know how much the price is. But this one, the asset is not in the asset, you can only use similar assets. And of course, you make some adjustments. And this input requires adjustments. Okay, I think you guys are getting it. Can we read the next one?
A manufacturing
Question 3. Okay. A manufacturing company owns a custom-built machine used in production. The machine was purchased 5 years ago for 200 million naira, and a similar new machine costs 250 million naira today. However, due to wear and tear, the machine has 20% depreciation. Required: 1. What is the estimated fair value of the machine? 2. What valuation approach should be used? 3. Under which level of the fair value hierarchy does this measurement fall?
Thank you very much. So here, the fair value is the replacement cost of the assets, right? If you look at this, they are talking about a machine they purchased 5 years ago for 200 million. You now said a similar new machine is 250 million. However, due to wear and tear, this machine has 20% depreciation. So now, if you say the replacement, you know that the replacement cost of this machine is 250 today. But this 250 is the price of a new asset. That cannot be the fair value of this old asset that you bought 5 years ago. But the best way to get the fair value is to depreciate the price of that new asset by the amount of depreciation this one has gone through. So since this one has gone through 20% depreciation over its life, then we can adjust this new price also, or this replacement cost for 20% depreciation. Okay, so I will just say that this replacement cost is the cost of a new asset. Hence, we need to adjust it for depreciation. Therefore, the fair value of the assets is, then if we are good with maths, it's simply going to be 80% of 250 million. If you quite get that. If you don't get that, it's like if you do 20% of 250 million, that gives you the depreciation, then you take that away from 250 million. Okay? So how much is this? What's 80% of 250 million?
200, sir.
200 million. So this 200 million will represent the fair value of this asset. So coincidentally, it's still the price it was purchased 5 years ago. Good for him. Then the valuation approach used here. Yeah, Damilola, you can go ahead, please.
Good evening, sir. Please, why are we doing 80% of 250? I thought said depreciation is 20%.
I actually mentioned it too, that you can do 20% of 250 million to get the depreciation. Then you do 250 million minus that, whatever you get, you still get the same thing now. It's just mathematics. Instead of going that long route, I just did 80%. When they say something is depreciated by 20%, so it's remaining 80%. So you can do your own like that, it still give you the same answer. You get the depreciation, which is 20% of 250 million. Whatever you get, take that away from 250 million. You can do it like that, so it's okay. So what's the we're using here?
Cost approach.
Thank you very much. That's the cost approach using replacement costs. Thank you very much. So what's the level of hierarchy here?
Level 2.
Yeah, that's correct. The fair value, level of fair value hierarchy. Why level 2 now? Because we're using.
Because we made some adjustments, sir, towards the price
Yes,
of the
exactly. And also we're using the
Using
price
the price of a similar asset.
of similar assets. And also we made adjustments to that price. Okay. Let's go to question 4. Who will read question 4 to us?
Fintech startup PayFast Limited is seeking investment. The company has no publicly traded shares, but financial analysts project that it will generate 1 billion naira per year in profits for the next 5 years. The appropriate discount rate for the industry is 10% required. 1. How should PayFast Limited estimate its fair value? 2. What valuation approach should we use? 3. Under which level of the fair value hierarchy does this measurement fall?
Okay. So in this case now, we want to value a company. So, and the company is not publicly traded. But analysts has projected that this company will generate 1 billion per year for the next 5 years, and the discount rate is 10%. So what's the fair value? So the fair value is the present value of future cash flows. That will be generated by the company. So how do you determine that? How do you determine the present value? So if you use here, the cash flow, the discount factor at 10%. So the year is 1 to 5. The cash flow, how much are we looking at? Let's say 1 billion. If I put this one as million, so this will mean, so if you use annuity factor, and I've shown you annuity factor before. If you use annuity factor to get the discounting, then you'll be looking at 1 minus 1 plus R raised to power minus N all upon R. All upon R. So can anyone punch calculator to get this for us?
3.79.
3.79. So our PV will be how much? That would be 3790. That is like a 3 billion 790,000. So the fair value is 3 billion 790,000. Right? So the second one is saying the valuation approach. So which valuation approach are we using here now? What's the valuation approach here?
Income approach.
Yeah, that's the income approach. Is the income approach you will use this for? So, I mean, it's quite straightforward. In the exam, it is asset like this that you would have to use income approach for, where you have to do discounting. You see them giving you discount rates, and they will tell you that the asset to generate so amount every year. You know that if they ask you to calculate fair value, you are using DCF. You will use DCF. So, and that's the income approach. And so which fair value hierarchy is this? Which level of fair value hierarchy is this? Level what? Can you tell me?
Level 3.
Yes, level 3 input, because it's using the internal data of the company, right? So it's the company that gave us the the 1 billion per year. So there's no way we will have known this 1 billion. They are the one. So this level 3 here, this level here is actually the level 3 inputs, and they are using the company internal data. Okay, so you see that all these questions, this question is making you get used to the valuation approach, the level of hierarchy, and how to even determine fair value itself. Okay, let's solve one more before we even solve much more questions. So, can somebody read this for us?
Question 5.
Okay.
Okay. Valuation of an unlisted bond. An investment firm holds 1 billion naira worth of corporate bonds issued by a Nigerian company that is not publicly traded. The only available market data is from from a similar company's bonds trading at an interest rate of 12%, while government bonds trade at 10%. Required. 1. How should the investment firm estimate the fair value of the corporate bonds? 2. What valuation approach should be used? 3. Under which level of the fair value hierarchy does this measurement fall?
Okay, so because this is the last question here, can we have a discussion on this? Is there anyone that can do the analysis for us here for this one? The investment firm owns 1 billion worth of corporate bonds issued by a Nigerian company that is not publicly traded. The only available market data is from a similar company's bond trading at an interest rate of 12%, while government bonds trade at 10%. Okay, you might find this a little difficult because they didn't give us how to directly determine the fair value here. Okay, so here now, since we have 1 billion bond, okay, and this bond is not publicly traded, right? So they said the only available market data from a similar company's bond trading at an interest rate of 12%. Why government bond um is 10%, and since you have a corporate bond, so you mostly use a similar corporate bond to do your valuation. So in this case now, okay, the fair value here will be determined. The fair value will be determined based on the value of the 12% corporate bonds. Okay, so the fair value of that bond will represent the fair value of the investment firm's bond. Okay, so in this case now, since we were not given, we only told, we only described, they only told about the 12%. So what the examiner is looking at is whether you're going to go with the fair value of the 12% or you're going to go with the fair value of that of government bond. So we would expect you to go for the fair value of a similar company's bond, right? Since you are also, your own asset is also a corporate bond that you are holding. So whatever the fair value is would represent your own fair value. I mean, a practical example is on FMDQ. There are corporate bonds that are quoted on FMDQ. Like they are actually quoted. People trade, they are actually traded securities. So if you are a company and you have invested in a corporate bond that is not listed on FMDQ and you want to know the fair value of that, what's the market value, you can just go to FMDQ and look at what's the fair value of a similar corporate bond, right? With probably maybe similar company, with the company in which you have actually bought or invested in their corporate bonds. So whatever their fair value is might represent your own fair value. But however, there is need to make adjustments. There's need to make adjustments for the fair value. because you cannot just pick up that fair value plan and sync and use it. You will need to make some adjustments. So that's number one. Number two, which valuation approach is this then?
The market valuation, sir.
Yeah, we're using the market approach. So we're using the market approach. Which level of hierarchy is this? The
Excuse me,
level of
sir. Why are we
fair.
using market approach? If I may ask.
Because we're using the market, we are using market information of a similar asset. And the similar asset here is the corporate bond of a similar company that is listed. So that's actually market information. Or what do you think? You think it should be cost approach?
No, I was thinking it should be income approach.
You know that income approach uses present value of future cash flows. So, and here we're not doing any present value of future cash flows. So there's no way we can attribute it to income approach. Sure you get?
Okay. All right. Yeah. Thanks.
Yeah. So the level of fair value hierarchy is level what?
Level 2.
Yeah, level 2 impute. It's level 2 impute because we are using the price of a similar asset. Okay, so I think all things being equal, you have a good knowledge of this. So if you have gotten it to this extent, then I think you're fine. Okay, I'm just opening the chat now. I can hear that somebody is saying that I'm fast. Really? I think I'm actually slow today because I'm actually tired, so I'm so very slow. And again, I think if you don't understand something, why not just ask? We are interacting. We're actually talking. You can stop me like the way your fellow students are doing. You can ask instead of complaining at the chat box. So you just tell me and say, this is the part you don't understand, and see whether I won't explain. So Charity, which part is it you don't understand?
Good evening, sir.
Good evening.
I don't know how to determine the approach, like the number two. I don't know how it's gotten or the scenario about it. Sir, did you hear me? Hello, sir. You're a liar.
The good Christ children.
What's going on?
Okay, yeah, sorry, I think it was can you hear me now?
Yes, sir.
Okay, so I said, is it this one you're talking about?
No, like the number two question of each of these illustrations, they usually ask what valuation approach is appropriate or what valuation approach is used here. So
Were you in
for
class last
the
week? Hold on. Were you in class last week?
no, sir.
Okay, all right. Okay, you can continue.
So for the five questions we've solved this night,
Okay.
I don't know how we do arrive at the number two, the valuation approach.
Okay, so actually we revised it a little bit because I figured a lot of you were not in class on Sunday. So, and I already told you that there are three valuation approaches. There is the income approach, and the income approach basically uses present value of future cash flows. That's the income approach. It's not more than that. So at any point in time where you would have to discount future cash flows to present value, that is income approach. And there's the cost approach. The cost approach uses the replacement cost of a similar asset, and that's typically used for physical asset like PPE or intangible assets. That's the scenario where you find cost approach. While income approach I mentioned earlier, you would only see us using it for maybe you want to value a startup, or you have an asset that they would give you the future cash flows and ask you to get, and they will give you some discount rate. You would have to use income approach in those cases. And there is the market approach. This market approach is basically using market prices, either of that asset itself or of a similar asset. So if you look at all these questions we have looked at, like in this particular one, we have market price of these shares. So that means we are using market approach. In this second one, we have market prices of a similar asset. That means we are using market approach. They give us market prices of a similar asset to this shopping mall in question. In this third one, they give us the replacement costs of a similar asset. And I told you that this cost approach is this scenario. It is always question like this that you find us using cost approach, which is the cost of a similar asset. That's a replacement cost. So because cost approach looks at replacement costs, so it will not jive to use the cost of a new asset, right? To now say is the fair value of an asset that you bought 5 years ago. No, now. So you will need to remove some depreciation. That's why the examiner gave us that, you see, this asset you bought 5 years ago, it has depreciated by 20%. So that means that if we are doing any fair value today, depreciate down to my 20%, so that whatever balance is your fair value, which is why when I wanted to get fair value, I did 80%. But ultimately, this is a cost approach, right? And this one also, for this company, you see that they gave us future cash flows and they give us discount rates, right? They give us the money this company can generate per year for the next 5 years. So we are using income approach here because we have to discount to present value, future cash flows to present value. And this last one also, you are using market prices of a similar asset. That's market approach. So it's if you can know these five, it's not more than that though. Most questions would revolve around, I mean, it will not be outside of this context that I've shown you. Okay, so have you been brought
I
up to date?
understand now.
Okay,
Yes, I'm good now. Thank you.
you're welcome. Okay, so let's solve more questions. What's time? Okay, it's 9:30. We can still solve more questions. Okay, can somebody read this for us, please?
Is it a question one?
No. This one.
Okay, question on principal or most advantageous markets. An asset
Yes.
is sold in two active markets, market X and market Y, at 58 naira and 57 naira respectively. WADEX does business in both markets and can assess the price in those markets for the asset at the measurement date as follows. All figures are assumed to be correct. So what is the fair value for
Okay,
X and Y?
good. Yeah, thank you very much. Now, we are moving to another area. Okay, the one we have left is the scientific way of determining fair value, where we use valuation approach as well as understanding the level of fair value hierarchy. Another way, which I've also mentioned as part of the assumptions that are made by market participants when I was teaching you the introduction, is that it assumed that fair value is determined in the principal or the most advantageous market. And I told you the principal market is the market that has the highest volume of activities on that asset, while the most advantageous market is the market that gives you the highest return on that asset. You see, I can ask you questions on how to determine fair value based on market information, based on either principal market or most advantageous market. And this one can expose us to that. So here, there's this company that sells in two markets. It sells in market X and market Y, and these are the selling prices of assets in that market. And this company does business in the two markets. So the selling price in that market in market X is 58, in market Y is 57. The transaction costs in the two markets are this, and the transport cost to transport the asset to the market is this. They are not asking us what's the fair value. So look at it, because I have not actually mentioned this to you before. Let's see if we can actually make sense out of this. So the fair value here, the fair value is the selling price in the principal market. In the principal market, after making adjustments for transport costs. Note that we do not deduct transaction costs in determining fair value, because transaction costs are characteristics of the assets. Characteristics of the assets and characteristics of the market and not the assets. Okay, so let's pay attention to this first before I give you the figures. Now, I said fair value is the selling price in the principal markets after making adjustments for transport costs. So what I've said, if I want to rely on this first sentence, is that let's assume that market X is the principal market. In that case now, that means the fair value is this selling price minus the transport cost of 4 naira. That means the fair value is 54 naira. If I want to use, let's assume market Y is the principal market. That means my fair value is 57 naira minus my transport cost of 2 naira, and that's 55 naira. Okay, then I went ahead and said that note that we do not deduct transaction costs in determining fair value, because transaction costs are characteristics of the market and not the assets. Because when we say transaction costs, then we'll be talking about things like probably maybe you paid a middleman, for example. You paid a middleman, or you paid some commission, right? These are market determined costs that you really don't have to incur. It has nothing to do with the assets. So they are characteristics of the market. So we should not use that to determine or affect the price of the asset. And not only that, transaction cost is highly subjective. It depends on the agreement you and that person have. So we cannot allow that to be deducted from selling price, because it will greatly distort the fair value. I mean, accountants can be funny. So somebody can just say, okay, my own transaction cost in this market is 60 naira. Or somebody can, I mean, people can just come up with a lot of figures for this transaction. So we cannot rely on that. We want something that we can objectively determine that, okay, we spent this on the assets, like transport costs. Probably you need to make on some update on the those ones is what we're talking about. So examiner in the exam, you always find this, that as far as determination of fair value is concerned in market, in principal market or most advantageous market, you need to ensure that you do not deduct transaction costs. You totally ignore it. So if that makes sense to you, then I will say that market Y, if market X is the principal market, then the fair value is 54 naira, which is the selling price of 58 naira minus the transport cost of 4 naira. Again, I will say if market Y is the principal market, then the fair value, is 55 naira, which is the selling price, that's 57, minus the transport cost, which is 2 naira. However, in the absence of a principal market, we will use the most advantageous what? Advantageous markets, which is the market that generates the highest return for the seller. In this case, or in this question, the most advantageous market is market Y, because it generates a return of 52 naira as against market Y that gives a return of 50 naira. Now, so if now from the above, since market Y is the most advantageous market, the fair value is 55 naira, which is the selling price minus the transport cost. Okay, so you need to just get the logic here. I want to believe you understand it up to assuming if each of them is this principal market. So why I'm doing this is because the question did not give me sufficient data for me to determine which is the principal market. So that's why I'm saying if X is the principal market, then the fair value is 54, which is selling price minus transport cost. If Y is the principal market, like that. And now I didn't stop there. And I said, however, let's assume we don't have principal markets, that we have many markets. Like in this question now, this guy does not have principal market because he operates in more than one market. So in that case, we will need to choose one of the markets. And what would help us is knowing which is the most advantageous market. And from the name, you're looking at the market where you sell. By the time you remove all your costs, you're making more money. And apparently from here, for market X, when he removes his transport, his transaction cost is at 15 naira. In market Y is at 52 naira. So obviously, market Y gives him more money. So market Y is the most advantageous market. Now, when that is established, knowing which one gives you more money, then you can say, okay, since market Y is the most advantageous market, then the fair value is 55 naira. Remember that fair value, you don't deduct transaction cost. Okay, you only deduct transport cost and any other directly attributable cost. So, and that's why to get the fair value is 57 minus 2. So, you see, what students find confusing, which I think should be very clear for you here, is that when they are determining fair value, so when they are determining fair value, you would then look at that which one gives the highest return. By the time they get the one that gives the highest return, then they will think that the highest return is the fair value. They will think the highest return is the fair value. Whereas that's knowing which gives the highest return is just to know which helps us to determine which is the most advantageous market. Which is the most advantageous market. So by the time we get the one that is the most advantageous market, then from that market, we can determine our fair value, which is this. Okay, I spent quite a lot of time on this. Now let's solve an actual ICANN pass question on this, which is May 2021, and which is the B part here.
Sir, hello, sir.
Yeah, Michael.
Sir, sorry, if we have incidental costs as in the questions, sir, how do we treat it?
When you say incidental costs, there are a lot of incidental costs. So let's look at one of the ones that will give you a specific incidental cost, so that will then answer your question, which is this question we want to look at now.
Okay, sir.
So let's look at this question, then that would attend to it from that angle. So can you read, Michael?
Okay, sir. Qatari PLC is a public limited company that is reviewing the fair valuation of its assets in line with the provision of IFRS on fair value measurement. The company has assets that are traded in different markets and is uncertain as to which valuation to use. The assets have to be valued at fair value under IFRS standard. Atakari PLC currently only buys and sells the assets in market C. Data relating the data relating to the assets are set out below. This, that, sir. So required, one, explain the three-level hierarchy for fair value, for fair value measurements used in IFRS 13. Two, discuss with relevant computations how Atakari PLC should value the assets under IFRS 13.
Okay, so this is similar to the question we just read, just that this is more direct. They give us every information that we require. So going straight to the point, the company in this case is Bacteri. So he wants to fair value some of his assets. So the company has assets that are traded in different markets and is uncertain as to which valuation to use. So the assets have to be valued at fair value under IFRS. And currently, Bacteri, they said he only buys and sell the assets in market C. So he only deals in market C. So the data relating to the asset are set out below. So they gave us information on market ABC at the end of the year. They gave us the volume of transaction happening in each market and the prices, the cost of entering the market, and also the transaction cost. So based on this volume, that is what would help you determine the principal market. Because I told you the principal market is the market that has the highest level of activity. Here now, the assets with the market with the highest level of activity is market A, since the volume here is 12 million. So it is from market A that we will determine the fair value. And the fair value is the selling price minus all incidental costs. And here now, the only incidental cost we have here is the cost of entering the market. Remember, we do not deduct transaction cost in determining our fair value. So since market A is the principal market, our fair value is simply 19 naira minus 2 naira, which is cost of entering the market. Okay. And note that the examiner knows what he's doing. If they had given you market C as the principal market, to determine the fair value, you know that you won't be deducting cost of entering the market again because this organization already, or this company already operates in market C. But we won't even get to that. So we will just use based on the information given to us to explain how to determine fair value. And if you look at the requirement of this examiner, it's not the calculation that matters. What gives you most of the mark is your discussions. So discuss with relevant computation. Okay, So before I write the solution for you, I think Omomi wants to ask a question. Can you go ahead, please?
Okay, sir. Sorry, I got logged out, so I didn't get your explanation. I think I came back when you were explaining the 12 million. So I don't know how you explained the 6 million and 3 million.
Okay, that's
Could you please
straightforward.
repeat it again?
Yeah, so what I was saying is that to get the fair value, you need to identify the principal market. And here now, they already give us the data to do that. They give us the volume of activity. And the market with the highest volume of activity here is market A. Is there, the volume here is 12 million. So market A is the principal market. And immediately we're able to identify the principal markets. Then is in that market that we will get our fair value. Okay. And we will then compute our fair value. So if I want to get my 4 marks fully, I would tell the examiner that to determine the fair value, we need to identify the principal markets. From the question, the principal market is market A because it has the highest level of activity. Therefore, the fair value is 17 naira, which is the selling price of 19 naira minus the cost of entering the market of 2 naira. Then I can just tell the examiner, however, if the principal market, cannot be determined, we'll use the most advantageous markets to determine the fair value. And from the question, the most advantageous markets, who can tell me the most advantageous market here? Which market is the most advantageous market here?
C, sir, is market C, sir.
Market C. Yeah, because let's look at it. The return in market A, 19 minus 2 minus 1. That's 16. 16 minus 4, that's 12. 22 minus 5, that's 17. Yeah, that's correct. The most advantageous market is market C because it gives the highest return of 17. Therefore, using the most advantageous market, market C, the fair value is 19 naira, which is the selling price of 22 naira minus the transport costs of 3 naira. With this one, you get your 4 marks. Easy. And ideally, this should not even take you 5 minutes or 6 minutes to really answer. Any question on this one? Any questions on this? So this is why, yeah, go ahead, please.
I thought you said transaction cost is not deducted. Why are we not deducting it here?
Did we?
Yes, you did.
How? Show me.
You said
I'm not sure,
you said 19 minus 2 minus 1, then 22 minus 5. Why?
Exactly. I mentioned it and you are still doing the same thing that I mentioned, the same mistake that I say students make. And you are still making that mistake again because over the diet, I teach students and they make the same mistake and you're still making it after I said they make the same mistake. I said that when determining the most advantageous markets, we use the market that has the highest return. So for that one, we deduct all the costs just to determine the most advantageous market. That's not the fair value. So now that we are use that one to get the most, so we said from the question, the most advantageous market is because it gives the highest return. And I'll say therefore, using market C, the fair value is 19 naira, which is 22 naira minus 3. So I didn't deduct transaction cost.
Okay. That value.
Can somebody read this one? Because this one too is on fair value.
Okay, Kantala Limited is a company based in Abeokuta, the Ogun State capital. It uses the revaluation model for its non-current assets. Kantala Limited has several plots of farmland which are unproductive. The company feels that the land would have more value if it were used for residential purposes. There are several potential buyers for the land, but planning permission has not yet been granted by the Abeokuta Planning Authority for the use of the land for residential purpose. However, preliminary inquiries with the planning authority seems to indicate that the planning permission may be granted. Additionally, the Ogun State government has recently indicated that some agricultural land should be used for residential purposes. Required, advise Kantala Limited on how to measure the fair value of the land in its financial statements.
Okay, this question was for 2 marks. So that goes to show that you should not spend more than 4 minutes. 4 minutes is even too much on this question. So, is there any of you that can give a try on this question?
Sir.
Yes,
Sir, hello,
okay.
sir. Yeah.
Yes, okay.
Okay. Look at the question. Although you said I should, you said try. And I don't want to waste time.
Okay.
Now in this question, now the Cantana Limited said that the land is unproductive, so it can be used for either residential. It uses evaluation. Sorry, Cantala has several plots of farmland which are okay. So it can be used either for residential or for farmland. So and now it has a lot of people who are coming to ask for it. Who are coming to ask. For price enquiries. So I believe is a principal market. It is operating it is operating in the principal. So I don't know. I feel I can try, but I don't know the right words. So, but I know it's operating in the principal business market, sir.
Okay, thank you, Michael. That's a good trial. Is there anyone that can try aside Michael?
Hello, sir. Using a cost approach
Okay,
because it
who's going
uses
first? Okay, Sarah, go. Let's
because
hear
it
you.
uses the replacement method. Replacements something.
Which one is replacement something?
Just realized that I did not complete. Maybe you were dictating. I did not complete what you wrote. But cost approach, sure, because it's it's supposed to be a farmland, but since it's unproductive, they want to use it for building. So cost approach, 2 marks or 1.5.
You're already even marking yourself.
Hello, sir.
Okay, Ufoma.
So I feel that in as the based on the scenario, for it to be valued as a measure at fair value, it must have the four basic elements, which are that it must have an exit price, it must be an active, there must be an active participant. Those four basic elements for fair value measurement.
Okay, that's nice. Okay, you have all tried. I mean, tried. 2 marks, you'll have all gotten 0/2 because you have not actually gotten it. So, in all we have discussed, the first part of our discussion was that definition that talks about those four elements. So, that was where Ifoma went. Then, the second part of our explanation was where we talked about assumptions of market participants, where we talked about market fair value is determined in principal or most advantageous markets, which we'll have sub questions on. Then another assumption is that the fair value of a non-financial asset is determined based on its highest and best use. That's the answer here. That's the answer here. So this I figured that, of course, I've mentioned it, but this question actually then exposes you to that better, because I can see why most of you are not actually getting it right. Okay, so for this one, if you find anything like this again in the exam, don't get it wrong, because the answer is very straightforward. The asset in question is a farmland, and we are talking about land, and they said that they are using it, in fact, using it for farmland is unproductive. And they say that the company feels that the land will have more value if you use it for residential. So, I mean, that's I can get the answer from here. That means the highest and best use for this asset is the residential purpose. And in determining fair value, we would determine it based on the residential purposes. And I didn't stop there. When I was talking about highest and best use, I said it's the use that gives you the highest benefit. And this use must be financially feasible, it must be physically possible, and it must be legally permissible. And which is what this other two paragraph is talking about. And this two paragraph is majorly talking about legal permission to use the land as residential. So they say that even though they have not granted approval to use it for residential, but they say that they have granted approval for a similar asset. So there's indication that they would grant it. So that means it's legally permissible. If this one has told us here that they will not grant approval to use the land for residential, that means the highest and best use will still remain the farmland, even though it's unproductive. It cannot be the residential because it's not legally permissible. Okay, so one of the assumptions made by market participants is that the fair value of a non-financial assets is determined based on its highest and best use. And the highest best use is the use that gives the highest benefit to the company, and this use must be physically possible, must be financially feasible, and legally permissible. From the question, the highest and best use is the residential purpose, and it's legally permissible. Okay. I mean, it will take me like 2 minutes to write all of this. So, I mean, they just expect you to have the answer at your fingertips for a question like this. When I saw it, I feel they should have given you like 5 marks for this. But the examiner believes that, okay, he's not asking you to calculate anything. Nobody is asking you to derive fair value or whatever. All they want to see is just for you to remember this highest and best use. And to tell them that it's the residential purposes that is because, and to explain all of this. So that's what the examiner is. That's why it says, I mean, 4 marks will have been fair enough for a question like this. It's not one of the most straightforward. That's all. Okay, so this is already 10. We can't go, right? We need to, let's see if we can see a question. If there's this question I saw. Let me stop sharing this. Let's share this rather. Which date is that now? Let's check November 2024. Yeah, it is. Okay. Let me share this. Present it. Let me share like this. Can you see my, hey, can you see my new screen?
Yes, sir.
Okay, good. Okay, so this is a question for 12 marks. This is a question for 12 marks. So what I can do, you know what? Let me take it away from here. Let me present the, let me take it into my comfort zone. This. Um, Anybody?
Okay, I'll read.
Thank you.
Indomitable PLC is reviewing its fair valuation of certain assets and liabilities in line with IFRS 13 fair value measurement. It carries an asset that is traded in different markets and is uncertain as to which valuation to adopt. The asset has been measured at fair value under International Financial Reporting Standards. At present, Indomitable PLC only buys and sells the asset in Market C. The data relating to the asset are set out below in year to June 30th, 2020. All figures are assumed to be correct. In addition, Indomitable PLC has acquired an entity on June 30th, 2020, and it is required to fair value a decommissioning liability. The entity has to decommission a mine at the end of its useful life, which is in 3 years' time. Indomitable PLC has determined that it will use a valuation technique to measure the fair value of the liability. If Indomitable PLC were allowed to transfer the liability to another market participant, then the following data would be used. Kindly scroll up, sir. So we have for the input and amount, all figures are assumed to be correct. So Indomitable PLC needs advice on how to fair value the liability. Required, discuss with relevant computations how Indomitable PLC should fair value the above assets and liabilities under IFRS 13 fair value measurement.
Okay. Thank you very much, Maumi. So let's look at this particular question and see. So, and if you look at this question again, please always look at what the examiner is asking you to do. They said discuss in most of your question, except the one they will tell you. In fact, it's mostly discuss. I will go back to that past question and show you all of the question for that diet. Discuss, discuss. If you calculate, you will not even get half of the mark. They said discuss with relevant calculations or computations. So the examiner is not so interested so much about your computation, but more about your discussions. So it's your discussion that will lead to your computation. Okay. So what do they want me to do? They said, how indomitable should fair value the above assets and liabilities? So that means you're going to discuss how it's going to determine the fair value of the asset and also the fair value of the liability. So I guess the information around the assets is up here. And so this company in Indomitable, it wants to fair value certain asset and liability. So second paragraph, it says that it carries an asset that is traded in different markets and is uncertain as to which valuation to adopt. Now, it says that the asset has been measured at fair value already under IFRS. And they said at present, the company only buys and sells in market C. They now went ahead and said the data relating to the asset are set out below for the year to June 30th, 2020. So they gave us 3 markets. They gave us the volume, the price, cost of entry, the market, and transaction cost. Okay. So I think the next paragraph is talking about liabilities, right? So from the information given so far, I can get the fair value of the assets. Okay, so I can tell the examiner that the fair value of the assets, can be determined in the principal market. In the principal market, this market is one which has the highest level of activity on the assets. Okay, that's the first thing I would say. You will see that I just went on to discussion around principal market because that's based on the information given to me. I know that they want me to determine based on either principal or most advantageous market, right? So I don't have to go and be talking about exit prices or daily transaction. In this case, now, it will not fly here. So here, what will fly is the discussions around getting fair value in the principal market. So since they have given me markets, right? And again, I will then go ahead and say that from the question, the principal market is market. Which market is that? That's market A. Because it has the highest level of activity of 20 million. Therefore, the fair value is, who can tell me the fair value here in this principal market?
It is 85, sir.
85. Thank you
90.
very much. What did you say?
It's 90.
90. No, it's 85. It's
85
actually
now.
95 minus 10. You don't deduct transaction cost in determining fair value. So it's actually 85. So the fair value is 85, which is the selling price 95 minus the cost of entering the market of 10. Okay. And that's that for that. You are done with that. Okay. So just out of curiosity, this one is not part of the answer, except if you have so much time at your disposal, you can just want to flex with the examiner. And I doubt they will give you any mark for that because you need to give them a fair value. Okay. So in this case now, if I may ask, what's the most advantageous market here?
C is a market C.
Market C. Yes, that's correct. It's market C. Because the return in market C is like that's almost
95. 95
95 already. Okay. So what's the fair value in market C then?
is 95. The uh, 95.
That's 95.
Yes,
Okay.
95.
Okay. And let's just always put it so that let's just say in the absence of the principal market, since it's 12 marks, the fair value can be determined in the most advantageous markets, which is market C, because it gives the highest return of 85 naira. Therefore, the fair value in market C is 95 naira, which is the selling price 110 minus the cost of entering the market. What's the cost of entering the market? Is it 15?
Sure, sir. 15 naira.
Yeah,
15 naira.
Okay, thank you. Okay, so that's that for the assets. I think we're already used to this one based on all the questions I've solved so far. Now, let's go to the liabilities. If you look at the second paragraph here, they said, in addition, Indomitable and acquired an entity on June 30th, 2020, and it is required to fair value a decommissioning liability. So the entity has to decommission a mine at the end of its useful life, which is in 2 years' time. Okay. So, I mean, the entire point here is that Indomitable bought a company and is supposed to get a decommissioning liability. I'm sure you know what a decommissioning liability is. It's like a provision for a cost you will incur in the future. If you remember IS 16 and also IS 37, speaking about the estimate of dismantling, removal, and restoring a site on which the asset was initially located. And such future costs we usually include it as part of the cost of the asset, and also we make provision for it today. So we call such cost decommissioning cost, and the corresponding liability is a decommissioning liability because it's a cost you will incur in the future. So, and if you remember that very well, you will know that to determine the value of that decommissioning cost, we usually use present value. So even without reading further, for my knowledge of IS 37 and IS 16, I will know that since they are talking about decommissioning liability, is a cost you incur in the future. That means the fair value here, I'm going to use this discounting factor. I'm going to use DCF, present value of future cash flows. I know that's what I'm going to use. So let's read further. So the examiner went ahead to tell us that Indomitable has determined that it will use a valuation technique. Yeah, I mean, it's DCF, is income approach they will use to measure the fair value of the liability. So if Indomitable were allowed to transfer the liability to another market participant, then the following data would be used. Okay, so what he's saying is this, that if I were to ask another party to help me do this decommissioning, to help me do this the entire hard work in the future, that this is the quotation that company is going to give to me. So the company will tell me that okay, for me to help you with this decommissioning, you are going to incur labor and material cost of 10 million. Overhead is 30% of your labor cost. And then I make some markup, let's say third-party markup in the industry. That means this third-party markup is like markup on the costs. That okay, just to be on the safe side, let me add additional cost of 20%. And also, let me also consider annual inflation rates. That okay, let's say inflation goes up every year. So let me add that to 5%. Also, let me also make some risk adjustments. That okay, what if, because of uncertainty of cash flows and all of that, probably maybe I have to go and borrow money from the bank or something, like maybe I won't have money to execute this project, I'm sure I'm making some risk adjustments again. So that means I'm increasing my cost again by 6%. So, I mean, these are all percentage increases, to be precise. Then they gave me risk-free government bonds and entity non-performance risk. Now, this too is majorly for discounting because by the time these are costs you incur in the future, right? From the labor cost, it's not like you're incurring it now, it's cost you incur in the future. So the fair value is the present value of that. So you will need a discount factor. And whenever you want to discount, you definitely use the market rate. You will definitely use the effective rate. So they give us risk-free rates. You know that by the time you add premium to a risk-free rate, that gives you the market rate. And this entity's non-performance risk is synonymous to like a premium, right? Entities non-performance risk. So hopefully a lot of you will be able to figure this out, that the discount rate to use is the risk-free of 7% plus the entity non-performance risk of 3%. Then the discount rate will be 10%. So the only people that will have gotten this question right, it eventually will be somebody that has probably seen this question before, or somebody that understands it so well, especially the discount factor, and know that for you to discount future cash flows to present value, you don't use just risk-free rate, you use market rate. Then since they are giving me additional non-performance risks, then I know that I will need to add that to get my market interest rate. So let's see how we put all that together. Yes, so Omomi is applying the knowledge you got from CAPM. Yeah, that will have really helped you in this case. So don't forget, it's not just about calculation. You need to discuss. So the fair value of the liability will be determined using the income approach by discounting the future cash flows to present value. So the calculations is as shown below. So how much is the labor and material cost? That's 10 million. Labor and material costs. Let's put them in thousands just so it can make sense. So this 10 million. Then overhead. Our overhead is
30%
30%
of labor.
of labor. Is it just labor or labor and material?
Okay, labor and material cost, sir. Labor
Okay,
and material cost.
okay, so that's 3,000. Also, there is third-party markup in the industry. So let's just mark the cost up. Third-party markup. Let's just mark up the costs for industry average. That's people in the industry spend more than 13 million because we are calculating 13 million, yeah? I say, okay, people in the industry spend more than that. So let's mark it up by how many percent? 20%.
20%.
20%. So let's do 20% of 13,000. What's that giving to us? That should be, am I correct?
You are correct, sir.
Okay. Also, we will do annual inflation rates of 5%. So let me add this together. So we are looking at 15,600. So if I do annual inflation rates, at which percent now?
5%, sir.
At
5.
5%. So that means I'm saying that let me increase this 15,600 by 5% every year. Let me increase this 15,600 by 5% every year. So it's like you want to get the future value of that amount. So how would you do that? It will be 15,000
15,600 times 1.05.
raised to power what? Raised to power 3, because this project will be done in 3 years' time. If you look at before this up here, the last line here, the commissioning will happen in 3 years. So if you are increasing this 15,000 by 5% every year, so it's like a compounding interest. So what does that come to? How will it come to?
18059.
Sorry?
18059.
Okay, 18059. And finally is let's make some risk adjustment of 6%. So risk adjustment 6%. So what's 6% of 18059? How much is that?
1084.
1084. So what's then the addition?
19143.
Okay, so this is then my future cash flow. Now, the fair value is the present value of the above future cash flows. So the PV is 19,143 into brackets 1.1 raised to power minus 3. What's the PV now? What do we have?